Hi all. I think you're allowed to say Happy New Year if you've not met up. Anyway, I'm going to say Happy New Year. Happy New Year to you, 2024. Curious year from the markets anyway. Yeah, who'd have thought at the beginning of 2023, a year ago, that markets would have behaved the way they have done? Just extraordinary, absolutely extraordinary. I was looking at the move that we've had since the end of October in US equities. I think it's one of the biggest weekly outcomes since 2004. I think what it was, 9 weeks or something. Just extraordinary. Anyway, yeah, I think to say that they've been on a tear, US equities, is an understatement. Not so much last week, obviously, but I'll get onto that in a second. But ever since the Fed signaled it was likely to end its tightening cycle, these were the minutes, not last week, but the previous minutes, and that the next move would likely be down, equities, US equities, have just gone nuts. I mean, they really have. And I think last week's move, albeit in a shortened holiday week, so remember we had New Year's Day off, last Monday was a holiday everywhere. We did actually see equities fall on the week, breaking this best weekly run for US equities that we've seen since 2004, according to the statisticians. So this is the weekly chart: 1, 2, 3, 4, 5, 6, 7, 8, 9 weekly gains. I've never seen that. I mean, it's really extraordinary. Seeing 9 weekly daily gains is extraordinary, but to see 9 weeks is very, very extraordinary. Anyway, US equities closed out 2023 pretty much close to, just shy of all-time highs, as optimism about interest rates pushed stocks higher. And it's a bit weird, isn't it? You know, we started 2023 with inflation still way, way above central bank targets. You remember in the UK, in November 21, we hit 11.1%. I know it's all changed now, but you know, we went into 2023 thinking, oh God, inflation, interest rates, cost of living crisis, energy crisis, our bills were going through the roof. I remember Bulb Energy or Octopus, whatever they're called now, putting my monthly payments up by, on I think something like £500 a month. I mean, it was just shocking. Needless to say, the radiators were turned down pretty quickly, and Mrs. Miller had to put a cardigan on or two. Anyway, for the record, in 2023, the Dow gained, so this is US 30, the Dow Jones. Let's just get back to D1. The Dow gained 13.77%. Now, you might think, geez, 13.77%, that's not bad. I mean, it's better than the FTSE here in the UK, which only tacked on just under 4%, mainly because we're quite resource heavy here in the UK and in the FTSE 100, and you know that struggled in the wake of China's woes. But then you look at the S&P 500, SPX 500. Remember to put those numbers in, please, as Stuart asked. Please, if you can, quickly tot them up. We'd love to see those numbers if you can. I'll keep reminding you. I'm sure the fine Mrs. Miller deserves a warm abode. Well, we have a log burner because we live right out in the country. This is not a middle class toy. It really does keep our 2 warm rooms very warm when we need them warm. That is, yeah. Anyway, so the S&P 500, 24.2%, 24.2% increase on the year. That is extraordinary. Extraordinary, bearing in mind what the scenario was at the start of this year. And I hear you saying, well, why would stock markets go up when interest rates are really high and still going higher? The Fed was still raising interest rates until the end, I think July was the last hike. Yeah. December combined, what DIS and Dow Jones Industrial Average, and DIS, what does that stand for? Anyway, very, you can just explain or just give me the nod on that one, Owen. But the Nasdaq was the knockout. The Nasdaq, if you look at Nasdaq, NAS 100, the gains on the Nasdaq went off the Richter scale. If you remember, by the end of the first half last year, when we did our review in the beginning of July, we were already up something like 33%. Well, courtesy of this rally from November, from 14,000 odd up to as high as 16,000, the Nasdaq ended up. Oh, I see. Apologies. I've got you. Okay. I do apologize. A complete non sequitur. Owen's given me his gains. Thank you so much. Owen has given me his gains. Paul, if you can give me yours. Anthony, anyone else, Jim, Ranjiv, Sid, if you can put your gains in, that'd be helpful. Thank you. The S&P 500, as I say, 24.22. The NASDAQ up 53.75%. Just outrageous. Now, I know you're all saying, but hang on a second, Jerry, I don't invest in the NASDAQ. Well, you probably do through your pension, you probably through some passive investments in funds, etc., which will have a big exposure to the US if you're in a sort of global macro fund. But it was actually largely down to what's called the Magnificent Seven. But actually, when you exclude the Magnificent Seven, the NASDAQ was still up, as it although it wasn't the case at the end of October. The Nasdaq, if you call it the S&P, for example, the S&P 493, removing the Magnificent Seven, was actually down on the year. Anyway, it's up even when you exclude the Magnificent Seven. When you include the Magnificent Seven, the likes of Apple, Amazon, Netflix, Nvidia, Meta, etc., then just extraordinary games. And we had some big games in Europe as well. The German DAX, which has got quite a few tech stocks in it, gained 21.3%. But as I said, the FTSE here in the UK, yeah, it really did struggle because of what was happening largely with the resource sector. I mean, I was looking at the likes of Anglo American down significantly lower last year, and that really just drags our index lower. And oil started to come off in Q4 as well, which really hurt our oil majors as well. So not a great year for the FTSE, gained only 3.86%. Anyway, in the last 8 weeks of 2023, as I said, they were the most spectacular. The Fed signaled in its previous meeting minutes that interest rates had peaked and that it expected to cut interest rates 3 times this year. 3 times. Not what this Fed Watch tool is saying. Oh no. The Fed Watch tool is calling for more than 3 interest rate cuts. Question is, who is right, which is always the question. Is the market right or is the Fed right? The thing with the market is that it's trading all day, all night long, and it's constantly giving us an update or telling us where interest rates are going to be, whereas the Federal Reserve updates us once every meeting, sometimes intra-meeting when you get a Fed official speaking at an event, but largely it's very patchy with the data we receive. Thank you, Paul. Thank you, Sid. Yeah, the forecast for 24, the Dow, S&P, and Nasdaq and FTSE. Paul says impossible to know. It's likely. They always say that the beginning of the year, the first full week, determines what happens for the rest of the year. That's some Deutsche Bank analysis, Paul. They also says that if January results in a fall, then the outcome for the year will be a down year. But it's also clouded by the fact that we got a presidential election. In fact, we've got elections all over the place. This is the year of democracy. I think we got Taiwan this week. There's so many elections taking place this year. It's really, really interesting, and including here in the UK, of course. Yeah, whenever that happens. Anyway, the Fed at its last meeting, the previous one in November, signaled, or was it October, signaled that its interest rates had peaked and they expected to cut interest rates 3 times. The money markets push bond yields lower. So what I mean by pushing bond yields lower, they push the price higher and yields fall, and those twin effects of falling inflation and the prospect of lower rates really pushed bonds higher, which caused yields to fall sharply, in fact. So the yield on the 10-year, so if I look at market data, quick look at bonds. So if I look at US bond yields, now this is only going to tell us, this is the 10 years, the benchmark that we look at. So these are sovereign bonds in the US. They're called treasuries, issued by the United States Treasury to finance its expenditure, and there are 3 lines. One is a turquoise line, which is the current yield. A week ago it was 3.9%. That's the orange line, and the brown one is a month ago. I can tell you that the yield touched 3.9% at the beginning of the year, having been above 4.2%, in fact 4.28% a month ago, so at the beginning of December. Anyway, when we look at the Fed Watch tool, I'm jumping around. Thank you very much for those numbers, Sid, Jim. Oh, Jim. Okay, I've got you. That's fine, Jim. Both Pauls, thank you. So what am I talking about? Well, get my thoughts processes back on track again. Anyway, so the Fed Watch tool, that's what we were talking about. The first rate cut has pushed even earlier this year. So when we were looking at this throughout the last quarter last year, interest rates were expected to be cut in May. Now, okay, so the first Fed meeting is on the 31st of January. Nothing is going to happen then. But the market now believes, isn't it funny how this is falling again? So this is showing the probability of a rate cut in March. Now it's showing at 61%. Well, if you add in the probability of a half point cut, it's about 64%, something like that. Well, I can tell you a week ago, there you go, see, a week ago, it was 73.4%. That's changed. So 73.4% at the start of last week. So you can see how expectations have actually come down since the beginning of last week. Last week, at the start of last week, the market was very optimistic. And obviously the difference between what the Fed has been saying and what the markets are expecting has widened. But often the Fed would be more cautious. And as I said a few minutes ago, and it only gives updates at its monthly meetings, whereas the market rates are trading all the time, reflecting the shift, in traders and investors' expectations. And I'd say last week, reality dawned on the markets because we had the minutes from the last FOMC meeting. So the last but one meeting, that's when the Fed became quite dovish and suggested that rates had peaked and that the next move would be lower and that they were looking to cut rates 3 times. Well, last week they released let's just get rid of the low impact data. I don't really need that. If you want to change the filter on Forex Factory, go to this little symbol at the top right. So if you're new to the workshops, you need to head to www.forexfactory.com. It's a nice, simple way of presenting the calendar. At the top right, there's this symbol. If you click on it, it opens up a filter, and you can choose the red one, which is high impact data. Definitely tick that one. We need to know about that. The medium impact data, yes, as well. The low impact data, I would not tick, because otherwise you have far too many elements to look at and it just gets a little bit confusing. And low impact data, we don't need to know about it. there's tons of data that comes out. A lot of it has little impact on the markets. And then there's one other, which is, oops, let's keep that checked, which is this non-economic. So that tells us about market holidays, etc. It's just good to know when they're happening as well. So when you're happy with your selection, just click apply filter. So there we go. So what we were looking at last week were the minutes. So FOMC stands for the Federal Open Market Committee. That is the rate setting committee of the Federal Reserve, the Federal Reserve being the US central bank, a bit like our monetary policy committee here in the UK, the rate setting committee for the Bank of England. These central bank committees meet, we call it monthly, but in fact they meet about 8 times a year. And these are the minutes from the previous meeting held in, when was it, mid-December, I seem to remember, 13th of December, that was it, I'm trying to remember. And it's those minutes that tell us what the Fed committee members were thinking. Anyway, so these minutes were released, I should say, and it stated that the Fed officials expected interest rates to stay high for some time. And it's not like earth-shattering news, and I think it's because the markets have got ahead of themselves. And I think those 3 words were picked up immediately by analysts. The Fed backed this up by saying that it reaffirmed that it would be, and this is a quote from their minutes, that it would be appropriate for policy to remain at a restrictive stance for some time until inflation was clearly moving down sustainably towards the committee's objectives. Let me put that in English. Restrictive means keeping monetary policy or interest rates tight, i.e. high, to choke off inflation further. And then when inflation heads back down to the Federal Reserve's target rate of 2%, that's when interest rates can start to fall. Of course, the Federal Reserve and other central banks don't wait till it's hit their target. It's a bit like steering an oil tanker. They have to think well ahead of the game, months ahead, and plan accordingly. So if inflation starts to fall, they've got to start lowering interest rates to ensure that the economy, the US economy in this case, does not hit the buffers. And that's really important. And that's what the market's looking to do when we look at the CME FedWatch tool, where the market is saying, well, we think the Federal Reserve are going to have to cut rates quite significantly. Well, guess what? Currently 5.25 to 5.5, expected to go to 5% in March, expected to go to 4.75. Well, that probability has shrunk a little bit, but it's still a 50-50 call. By June, it's possible that we could be at 4.5, definitely 4.75 by July. Do you see what I mean? So definitely 4.5, maybe 4.25 by year end. 3.75, possibly. It's 50-50, isn't it? 35, 45, 51, 52. So it's close. Interest rates are expected to go down. But when you look or listen to what the Fed said, they are predicting 0.75 points in interest rate cuts. Wow, look at this. This is 1.5, double what the Federal Reserve is saying. Anyway, but it was that bubble that was pricked last week that caused the problem. So come, let's put up S&P 500. So it was last week, last Wednesday. So that's this candle here, when markets suddenly had a reality check, and the probability of a rate cut in March fell from 73.5% down to 63%. Yes, it's even lower today, but it's the fact that the market, it's dawned on the market that interest rates may not come off as quickly as perhaps market participants were hoping. And that's the reason why you saw a fall in equities last week. So the Fed are effectively signaling that the interest rates are unlikely to be cut in March, although the CME FedWatch tool still thinks there's a greater chance that the interest rates will be cut in March with a 63 probability, something like that, 60.9 and 2.9 on a half-point cut. So the markets are now sort of primed, really, to react positively to weak economic data. And I'm sure you're thinking, hang on a second, Joe, weak economic data is not good for the markets. Well, perversely, weak data will encourage the Federal Reserve to think about cutting rates, and strong economic data is likely to dent confidence in the fact that the Fed could could ease rates as early as March. So it's in that sort of slightly mixed up world that we are inhabiting just for now, whilst the weak data is good for the markets and strong data may not be good for the markets. Anyway, last week we also had non-farm employment change, normally a very, very important piece of data for the markets, probably one of the most important ones along with interest rate decisions. And we had that last Friday, the first Friday in the new month, the new year. It appeared to be stronger than consensus. And actually the market did rally. Initially the market fell, but in fact, detailed analysis of the non-farm payroll, although all the metrics were stronger than expected, the Fed member came out and said that it was all part of the normalizing of the employment market, and there were elements of it, I think, that helped the market understand that the employment report wasn't quite as strong. Anyway, we then got a weak ISM services PMI data. This is a measure of how well the service sector is going. And remember, the service sector in any developed economy is a lot larger than the manufacturing sector. So services are absolutely key, especially here in the UK. We have more than 80% of our GDP come from services, very little from manufacturing, very little. So whatever happened, the ISM services report helped the market rally, curiously, but despite Friday's gyrations, equities actually closed out the week with losses for the first time since the 29th of October. Wow. No problem, man. All the best. Currencies very quickly. Let's have a look at that. I'm waffling too much. It's the first week of the new year, that's why. So the dollar recovered a little bit last week. The euro, one of the key elements of the dollar index, occupies 56% of the dollar index weighting. The dollar tends to find support in the new year. So seasonally, the US dollar does well in Q1 of any new year. And last week's move sort of followed that playbook. The minutes from the last FOMC meeting, as we've just been discussing, supported the US dollar as traders factored in, I suppose you could call it, the diminished probability of a rate cut in March. Inflation data from the Eurozone also came in stronger than the previous month, although weaker than the 3% expected, came in at 2.9%, and that's the first rise in inflation in the Eurozone in 6 months. So you can sort of get a feeling of what's going on here. Interest rate expectations are a big driver in the markets. And remember, stock markets aren't about the here and now. Stock markets, as we found out from last year, they're looking at least a year, if not 15 to 18 months forward, and predicting a turn in interest rates, albeit interest rates continue to rise until July last year in the US. So that's what's driving those markets. What's going to happen this year? Wow, quite a difficult one. Possibly the markets will struggle, and so far this year, the tea leaves, yeah, not brilliant. You normally get a bit of a bang in the start of the year, and that's certainly not what's happening, or certainly not what's happening in the US, that's for sure. Anyway, precious metals, just very quickly. I think Stuart was focusing on gold. Gold closed above that psychological 2000 level. And remember, as Stuart mentioned, when it provides that barrier to prices rising, as it did on several occasions last year, once it goes through it, that 2000 level that proved to be a bit of a barrier then becomes a bit of a support mechanism for the markets. We posted a modest decline in gold, what's for $18, less than 1%. But gold, more than anything else, tracks the US dollar, and we've already discussed the US dollar firming. And all dollar-based commodities, when the dollar firms, it causes downward pressure on any dollar-based commodities, and obviously with interest rate expectations, which really do affect gold independently as well, not just through a weaker or stronger dollar, but the cost of holding gold is dependent on interest rates. So if interest rates are quite high, the opportunity cost in holding gold goes up, and so it's not so attractive. Anyway, that picture got a little bit more negative for gold, but it really just depends on how that fluctuates over the coming days that will affect gold. But for the time being, it looks like it will hold on to that $200 level, $2,000 level. But with any market, higher highs and higher lows is all about a strong uptrend, and that's you'd hope that gold will at least not go below that sort of 1980 1980 level. Oil, yeah, down. Sorry, up last week. Just over $2 on US oil. On UK oil or Brent that we're looking at now, just around $1, and a half. Looks like reacted to the ongoing risk to shipping through the Red Sea. Had a number of major shipping lines continue to divert cargo around the Cape of Good Hope, that's the bottom of Africa, instead of through the Red Sea and the Suez. And there's a significant additional cost to freight and the delay as well. And I know Secretary of State, US Secretary of State Antony Blinken is in the Middle East now, visiting the UAE and Saudi Arabia to try and head off an escalation in this Israeli-Hamas war in Gaza. And obviously, if that war does escalate, and it was always something at the beginning of that war in middle of October last year that the markets got really worried about, and that's what pushed oil sharply higher at the time. But since then it's peaked and it's come off significantly. But I still think, if the war does escalate and bring in the likes of Hezbollah and the Islamic Jihad and other militant groups, then I think the upside for oil, it could be quite significant. Certainly back above the $90 level, should that happen. I'm not saying it is going to happen, and that's the reason why Antony Blinken's out there trying to find out, trying to ensure that it doesn't. Anyway, let's get on. This is the first full week back for markets. Let's get to January, might be helpful. So week starting the 8th of January. We got a holiday in Japan, celebration of coming of age day. I'm not sure which age. I'll be turning 65 this year. That's coming of age. My daughter's 20. One of my daughters is 25 today. That's coming of age. I don't know what age this refers to, but anyway, they have a lot of interestingly named state holidays in Japan, like Tomb Sweeping Day. But anyway, it's a holiday. We also have inflation out. A lot of inflation data out this week. In fact, it's a quietish calendar week, but inflation is a focus, and also GDP out in the UK. But the first sort of inflation reading that's already come out, the consensus in Switzerland was for a month-on-month fall. We don't normally talk about data from Switzerland. It's not so relevant to international markets, but the data came in unchanged, which I don't know whether that sets the bar for the rest of the inflation releases this week, but the market was expecting a slight decline, a month-on-month decline from Switzerland, but that did not happen. Rajiv, can you please advise if the holiday in Japan, then will it affect the impact the JP and pairs? Yeah, it will do. A lot of trading, especially overnight. Obviously, Japan, had it been open, Rajiv, would be closed now, in which case, the foreign exchange desks, a lot of these big banks, they've got multiple centers that pass their risk desk, their positions from desk to desk. And the UK is one of the biggest centers for foreign exchange globally. So a lot of yen is traded here anyway, but it shouldn't have too much of an impact. Obviously, the Nikkei is closed, so the impact on JP55, it would be trading electronically because a lot of markets do, and this is quote, I think they trade it on the CME, the Nikkei futures. I'm not sure. I need to find out more. Or maybe the brokers just quote a synthetic price like they do in the middle of the night for the FTSE and DAX. Yeah. So yen pairs, not much. There won't be much change in their liquidity today, no, I'd say. Back to the calendar, nothing on Tuesday, nothing significant anyway, no key releases. Wednesday, we got another inflation reading from Australia, expected at 4.5% inflation, so it's a little bit higher than other economies. It was last at 4.9%, but in fact, in October, inflation jumped back up to 5.6%. So they're in a slightly different position in Australia. So one of the few developed economies that are still experiencing a fall in inflation because they had that uptick in October. Anyway, the Aussie dollar will be sensitive to that release. But by the time you see that data when you get in on Wednesday morning, it has already happened. Unless you're a night hawk and stay up all night, in which case we'll see it real time. UK, we have the Bank of England governor, a chap called Andrew Bailey. He's testifying in front of the Treasury Select Committee in the UK Houses of Parliament. It's about the financial stability report, and it's unlikely to cause any waves. I'm not sure why it's been given a red impact number, whereas Thursday's release of inflation in the US is definitely key, and that's very much should be a high impact reading. The headline inflation is likely to rise to 3.2%, and that's to do with the way it's calculated. It's a year-on-year number, and it's because falls in the latter part of 2022 fall out of the calculation now. So the headline inflation is expected to go higher because that data has fallen out. But the core reading is expected to dip below 4%. We don't, or Forex Factory don't show the annual reading. This is the monthly reading, but the annualized reading on core is expected to dip below 4%. And that will be the first time since May 2021. When prices had started to accelerate. Anyway, the dollar assets and international assets, major assets, will be quite sensitive to that data release on Thursday at 1:30. Friday, we have Friday early, we've got overnight, we've also got inflation data coming out of China. I mention that because not many people trade Chinese assets. They do affect our markets, they affect the Hang Seng, and they do affect Western developed markets as well. But wow, what a difference in China, where the economy has really struggled throughout 23 following the decision to end the rolling lockdowns because of COVID. Just that was a complete bad decision to have those rolling lockdowns, but China never really recovered. Q1 last year, China recovered, but since then it's been downhill all the way. And inflation, they're really struggling with deflation, if anything. And here we have another fall, but most economists think that the deflation in China is temporary, but that will really, no problem, said all the best, that will affect China and perhaps in other related markets, but certainly quite a different scenario in China compared to the West. And then finally, just the one we mentioned earlier on, UK GDP data. This is monthly data. That's the figure there that I'm highlighting. It's really the quarterly data we look at, but we're looking at this monthly data. It's for November, a rebound of plus 0.2% following weaker than expected manufacturing activity. And this was all a bit of a surprise, really. And I think this data forms part of the fourth quarter GDP, the quarterly data that we always used to get on its own. We never used to get monthly data, and that'll be released early next month. And it actually could signal that the UK has entered a technical recession. Now, a technical recession is one that has 2 quarters of negative growth. So 2 quarters, we've had 1 quarter, the third quarter was negative, minus 0.1. The fourth quarter will be another quarter if it turns out to be negative. Now you might say, well, what does that mean? Nothing much, because it's just virtually, there's no growth, whether it's minus 0.1 or 0. It's backward looking. Whether it's does or does not signal a technical correction, technical recession, I should say, growth is expected to remain weak. There you go. So will it affect the markets? Probably not, but it's interesting to see that number. And finally, fourth quarter earnings season for banks. Well, actually, the stock markets in the US, but this week the focus is on banks. And on Friday, we've got the likes of BlackRock, Citigroup, JP Morgan Chase, Wells Fargo, Bank of New York Mellon, and Bank of America. So quite a key day. And the focus from those banks is going to be the level of bad and doubtful debts. So having had their annus horribilis in 2023, US banks are hoping to recover somewhat this year, but that'll be a big determinant in how badly they're going to be hit by impairment charges on their loans. That's it. I'm sorry it's gone on for so long. Listen, have a very good rest of the week. We will resume all things next Monday. In the meantime, happy trading. All the best for now. Bye for now.